Welcome to Talk Tickers, where we break down the latest earnings calls. Today, we're diving into Leggett Platt's third quarter results from October 28, 2025, and this one was a real head-scratcher.
Let's just jump right into the big question, right? How does a company miss on earnings and revenue, yet see its stock absolutely soar? It seems completely backward, but there's a fascinating story here.
And here's that disconnect in black and white. Adjusted earnings per share missed by a penny. Revenue came in about $30 million light. And the market's reaction? A massive 15% pop on huge volume. So what on earth did investors see that the headline numbers were hiding?
Okay, before we get to the why, let's quickly get the official numbers out of the way. This is the stuff that caused all that initial confusion.
So, as you can see, revenue was about $1 billion, down 6% from last year. Adjusted EPS was 29 cents, just missing the 30-cent consensus. But take a look at that last line, operating cash flow. That was up $30 million, and that's our first real clue that something positive was happening under the surface.
And if you break it down by segment, you see the weakness was really concentrated in their residential-facing businesses. Bedding products, their core was down a pretty rough 10%. So again, it's crystal clear the top-line demand story was not the reason for this rally.
And that brings us to the real story. This is the crucial point. The market was looking right past the soft sales numbers. Instead, it was cheering for management's decisive action on the one thing they absolutely could control, the balance sheet.
You know, the CEO, Carl Glassman, he set the tone right at the top of the earnings call. He basically said, look, we know demand is soft, but that's not the story this quarter. The story is about discipline and strengthening our financial foundation, and Wall Street loved to hear it.
And they had a simple and frankly beautiful playbook for it. 3 easy steps. 1, they sold off a non-core business, their Aerospace group. 2, that sale brought in about $250 million in cash. And 3, they immediately turned around and used that cash to attack their debt. Clean, simple, effective. And the result? A whopping $296 million in debt paid down in a single quarter. Now, this wasn't just a minor tweak. This was a huge de-risking event for the company, bringing their key leverage ratio down to a much, much healthier 2.6 times.
And it wasn't just about paying down debt with a one-time sale. Their deeper operational restructuring is also starting to pay off big time. They're creating a leaner company that's on track to be $60 to $70 million more profitable every single year. We're talking about a structurally better business emerging here.
All right, so they've cleaned house. The balance sheet is in much better shape. The big question now is, what's next? Let's see what management is telling us about the road ahead.
And the key word here is reaffirmed. They didn't raise guidance, but they didn't cut it either. By holding the line, they're basically signaling to the market that they think the worst might be over. It's not a call for a massive rebound, but it is a sign of stabilization.
Now that said, they're not putting on rose-colored glasses. Management was very clear that the environment is still tough, the consumer is still cautious, there's a lot of price competition out there, and you've always got those bigger macro risks to worry about.
So, let's put it all together. What does this mean for the stock going forward? This brings us to our final segment, the next call, where we lay out our thesis for Leggett & Platt.
We're assigning a market perform rating here. And you might ask, why not something more bullish after all that good work? Well, it's because the market has already reacted. That huge 15% rally is priced in a lot of the good news on the balance sheet. For the stock to really take the next leg up, we need to see proof of a real recovery in their end markets, and we just don't have that yet.
Okay, but for the investment committee, here's our outrageous but plausible trade idea. The core thesis is this. The biggest risk, the balance sheet, is basically gone. That puts a solid floor into the stock. So the next catalyst is any sign of life on the top line. We think the market will aggressively reward even a hint of stabilization. So if holiday quarter data comes in just less bad than feared, the stock could pop again. The idea? Look at what the options market did right after earnings, a huge spike in activity. You could look at some near-term, out-of-the-money calls to play for another sentiment shift. The big risk, of course, is that the macroeconomy gets worse and hits consumer spending even harder than people think.
And that wraps up our look at Leggett & Platt's third quarter. As always, please remember this is not financial advice.